if you want to do some extra work and extra resources. Does that answer your question?
Yeah, it does.
Okay.
Thank you.
All right, so not to scare anybody, I've posted course notes, approximately 400 pages. Not to worry, we will not cover 400 pages of course notes. That encompasses Tax 1, which you've already covered in ACCO 340, Tax 2, which I'm going to cover this semester with myself in ACCO 440, and the CPA program. The reason that I've done that, for a variety of reasons, you may have taken ACCO 340 a year or two ago and you may have forgotten certain issues. There are a lot of rates or provisions if you took it 2 years ago that may no longer be relevant. So at least if you need to go back and consult, you all have it in one package, and if you do forget something, I can direct you back. So again, we'll only be covering the aspects in ACCO 440 within the class notes. So we won't cover all 400 pages, not to worry. There is a table of contents I'll walk you through, and you can easily reconcile the topics to the course outline. Everybody okay with that? Everybody clear with that? What I will be doing for whatever reason you can't make it to class, you don't feel well, I will be recording the class, so it should be after the lecture, uploaded automatically by Zoom. It might take a few hours, it might be overnight, but eventually it will be accessible to you. And if you weren't able to attend class, or you just really want to revisit an issue, it is there. So are there any objections on anybody's end? Because if you don't black out your screen, you might appear in the recorded video. I just want to confirm no issues? Okay, perfect. So look, I'm going to start recording the class as of now. So I just want to confirm on your end, do you all see a recording button on your screen?
Yes.
All right, perfect. All right, so I'm going to try to share my screen now, so you'll just have to bear with me. We'll go through the course outline. All right, so you should all see the course outline as of now. And sorry, when I do post something, when I do share my screen, I don't see the chat button. So it would just be easier if somebody can just verbally respond. It just makes it a little bit easier for all of us. So I guess you can all see the course outline?
Yeah.
Yeah, great. All right, so this is Tax 2. I'll go back in a moment through the course evaluation. I'll really discuss what we'll cover in Tax 2. Then I'll get into the kind of the administrative stuff in terms of evaluation and textbook. So essentially, it's a continuation of Tax 1. This course has been watered down significantly, I would say, as of last year. So what I mean by that, a lot of the material used to be in ACCO 340, and the material was kind of, some of it was split into ACCO 440, and some of the material in ACCO 440 was removed. So it should be more feasible, at least in the last 2 years, to do well in class. So tonight we will cover capital cost allowance, which is depreciation for tax purposes. That used to be in ACCO 340. Following lecture, we'll cover income or loss from a business. So that's simply reconciling from accounting business income to income for tax purposes. Then after that, we get into kind of what I call pure Tax 2 material, which is taxable income compliance for corporations. So we have a few lectures, 2 lectures, 3 and 4. I'll just warn you ahead of time, and it's not really to scare anybody. The first time you're going to take a look at this, you might have, for lack of a better expression, an allergic reaction, really not to worry. We'll try to explain it in a way that you understand the rules, and then after that, yes, there are complex calculations, but it's really understanding how the model works. And once you understand how the model and the framework works, all those calculations just make more sense afterwards. Right? So, not really to worry too much. After that, we'll continue with investment income. That's just the continuation of corporate tax. Corporation earns passive income. You'll see that it is clearly disadvantaged as opposed to an individual. We'll talk about assignments and quizzes afterwards. So then you'll have your assignment due, your midterm. Following that, we'll talk about other issues in corporate tax. So like R&D, research and development, owner manager remuneration in lecture 7. Lectures 8 and 9 we talk about, and really lectures 10 and 11 all deals with M&A activity, mergers and acquisitions. So rollovers under section 85 are simply tax deferred transactions, so a way to do it in a tax efficient manner. We'll go through other type of rollovers that are used in estate freezing, what happens if you sell your business versus selling your shares. Finally, we will then continue on to partnerships. We'll then cover returns and payments only for corporations. So you have to pay installments, for instance. How much installments would you have to pay? And lastly, we'll talk in lecture 13 about trust and estate planning. So it's really the overview of the class. What I will say is this material, two things. Obviously, you're going to have to know your tax 1 material to a certain degree. If you did forget it, that's why I have included the tax package. You can go back and at least consult with certain elements. The next common question is the final cumulative. So my answer is, by its very nature, just tax is cumulative, right? So whatever you do in tax 2, we expect that you know tax 1. And whatever you've learned prior to the midterm, but the material after the midterm will certainly build on those elements. So you might not get examined on the same thing, but you'll need that as a building block really to go further on in the course. So everything is important, and please keep up to date. In terms of evaluation and textbook, so you have my course notes. They're quite detailed. While they are quite detailed, they're not a substitute for the textbook. Obviously, this textbook will give you, background information. The other question that I keep on getting every semester, and I'll try to answer this preemptively, so what happens if I have a previous edition of the textbook, i.e. 2019, 2020? Could I still use that? And my official answer will be the 2020-21 edition is the required one. And you might not want to use an old version for the simple reason, some provisions are no longer applicable. There are some new provisions. Rates have changed as well. So if you're using an older edition of the textbook, only 75 to 80% of it will be good. In terms of the course evaluation, so you have 3 online quizzes, and you have what chapters they will cover, and you have the dates. You'll notice the dates are scheduled for a Friday. So that is not done by me, that's done by the course coordinator. That is not specific to our section, it is for all sections. So in other words, the course coordinator doesn't want one class or the other to have an advantage, so she's just scheduling it all at the same time. So, I guess the marching orders that I've received from the course coordinator is the following. We understand that some students, may be working. If that's the case, we ask you to ask your employer to take some, 20 minutes off to write this online, quiz. If for some reason that can't happen, I really have no authority. What I would ask you to do is email the course coordinator, and you can, put me in CC and explain your situation, and it's really going to be her call. You'll notice that the first online quiz is in 2 weeks from now, and it will cover tonight's lecture, being Chapter 5, CCA. So we have a full lecture. The midterm will cover lectures 1 to 5. That will be administered online via Moodle. And it's the same thing for the tax home assignment, which will be a corporate tax topic. You have the particularities with respect to the case. Any questions or preoccupations so far? And again, if you do have them, just state them orally. It's just going to be easier than I can't see the chat feature.
Is chapter 5 and 6 purely tax 1?
It used to be tax 1. It is no longer tax 1. So what I would say, if you took this class 3 years ago, if you took ACO 340 3 years ago, you would have seen those in tax 1. But a lot of elements, at least with respect to CCA, have been updated. I'm not sure if that answers your question.
Yeah, that answers my question.
Any other questions or preoccupations?
The date for the midterm, the one it shows on the course outline, is that the final one, or it's subject?
My understanding at this point, it's tentative, but tentative is pretty close to final, right? So again, if there are any preoccupations, email the course coordinator. Please CC me if there's conflict for whatever reason, and she'll make the call. But that will be subject to confirmation as we progress closer to the date.
Okay.
Any other questions or preoccupations?
Will there be tutorial sessions this semester?
I'll get back to you on that. I know in past semesters there were tutorial sessions. I'm not sure, what happened. I wasn't teaching this class in the fall, so I'm not sure, as we've moved to virtual sessions, if there are, but that's definitely something I can inquire and get back to you on. So I'll ask the coordinator, and I will post an email this week, or if there is one, she might just communicate with you. So I'll follow up with that.
Yeah, for the first assignment, for the home tax assignment,
Yep.
at what will it cover all the material up to that point? Like at what point would you recommend that we have enough knowledge that we can start tackling that assignment?
So it's going to be posted after lecture 4. So by the time we've covered lecture 4, you'll have. So I've highlighted it here.
Oh, okay.
So
Yeah.
sorry. My mistake that I didn't emphasize that. So by the time we've gone to lecture 4, we would have covered the material, and then that assignment will be posted on. So you'll definitely have the knowledge to complete.
Okay, fantastic. Thank you, sir.
Any other questions? All right, so I'm going to move on straight to, I'm just going to load up the notes here. Just bear with me. All right, so CCA is on page 81. My version, the numbers might be slightly little off to your version, but I'm hopeful that it's not that much off. So around page 81. Before I do that, I'm just going to go to the very beginning, just so you have a level of comfort going through this. So this is the table of contents of all of the material in the CPA tax package. So as I said, it includes, tax 1 stuff, residency, employment income, other sources, property income, capital gains. So, if you forget certain material, you can go back and consult. So in terms of reconciling what is on, what we will cover this course, clearly you have the course outline and you have the table of contents, and it's quite a simple exercise. So tonight we're covering, CCA, depreciation for tax purposes, page 81. Next lecture we're covering business income, so 101. Lecture 3 and 4, taxable income for corporations, page 180. So just so you're able to kind of navigate through the course package. That's good with everybody? All right. So do you all see the tax page 81 here, tax depreciation?
Yes, sir.
All right, excellent. So the way I like to function is the following, and we'll see this semester, teaching online. I also teach at McGill online. I'll just give you a background a bit about myself. I've been teaching at Concordia and McGill since 2007. I'm a CPA. I've been working at Revenue Canada for the last, unfortunately, 20 years. I have a master's degree in taxation, so this is kind of my, for lack of a better expression, my bread and butter. So the way I like to function is I like to lecture, and where possible, I like to, demonstrate through practical examples the material. So generally, as a Blackboard, what I will use is PowerPoint. I won't use it for this lecture simply because the examples are embedded into the notes. But at times I'll use PowerPoint as All right. So I would just ask if if you can, other than myself, if we can just all be on mute. I know sometimes it comes off, and if you do have a question, just simply ask it. It just a little bit easier for everybody. So tax depreciation. So the relevant terms vis-a-vis accounting, acquisition cost for accounting. Capital cost is the relevant term. So how much you've bought the asset for. In accounting, you call that amortization. For tax purposes, we call it capital cost allowance. So as I move forward, I'm going to call capital cost allowance simply the acronym CCA. So anytime you refer to CCA, depreciation for tax purposes. Your capital cost minus your CCA gives you, and I'll show you how that is computed, your undepreciated capital cost. And it's on your undepreciated capital cost that you can claim CCA. I'll walk you through the procedure in a moment. So again, for undepreciated capital cost, we're going to use the acronym UCC, beginning letter of each word. So a couple rules of thumb, and please don't neglect these rules. So this is what I call the baby basic rules, but if you refer back to the baby basic rules, most of this goes well. If you tend to forget the baby basic rules, there are chances that you'll have or perform some mistakes. So first thing I want to state is CCA is a permissive deduction. So in other words, if I compute that you're allowed $100 of CCA, I'll show you how to compute that in a moment. I can claim, I don't have to claim the full 100. I can claim anywhere between 0 and 100. I can claim $7, I can claim $50, or I can claim 92. I'll just throw it out to the class here, and feel free to chime in. Why wouldn't I want to claim the maximum? Any thoughts?
Maybe your net income for the year will be like around 0 or maybe negative, and you'd want to defer that to another year.
Yeah, you're somewhat on the right track. So perhaps what you're saying is, let's say my income, I calculated I'm allowed CCA of $100, but I only have net income of $30. Would I need to claim all of the whole 100, or would I just claim 30 to bring me down to 0?
30.
Exactly. So I would claim the 30. Whereas the gentleman just presented is if I have no net income at all, I wouldn't claim any CCA, even though I'm entitled. So that's the first thing you should remember.
Sir, does this rule change for corporations?
It does not change whether you're an individual or a corporation. It may change on the type of income. So what you've learned in Tax 1, and you can simply consult the property income section, is for property income, you can't claim CCA to create a loss. That is not true for business income. The rule, again, I'll restate that, what you've learned in Tax 1, for property income, under rental income, you can't claim CCA to create or increase a loss. But when that comes to business income, which we'll cover next lecture, it's not a problem. You can definitely use CCA to create or increase a loss. But that may not be advisable from a taxation point of view. Does that answer your question?
Yeah.
Perfect.
I have another question.
Yeah.
If the asset is partially used for personal use, then does it get like a percentage of CCA for business, or?
Yeah, so we'll get to that. If you give me maybe 30 seconds, we'll get to that in point 3 here, where I say must be used to produce business or property. So absolutely, you only be allowed the proportion that you use to earn business income, not on the personal use. That's good?
Yeah.
So you can't take CCA on non-depreciable property. So what is non-depreciable property? I've outright stated it for you. Land, receivables, inventory, investments. So what are investments, just so we're clear? And jot this in, or you can take notes. What would be an investment? Would shares be an investment?
Yes.
Yeah.
Yeah, so you can't take CCA on shares. How about a bond?
Yes.
Okay, so all types of investments you can't, as well as personal use property. So in line with the previous question, in line with point 3, you can only take CCA to earn income from business or property and not on personal use property. So, you have a clarification on both ends. I just quickly want to come to land. Be very careful when you get land. So, generally how it's presented, what generally is on land?
A building?
Building. So you can take CCA on the building, but you can't take CCA on the land. So just be very careful. If, in the problem it says you acquired property that is worth $1 million, 300,000 is attributable to the land. So that means you can take CCA on the building that is worth 700,000. This is the general rule. At times we'll deviate away from it. We'll get into the exceptions as we progress through the class, but the asset must be owned by the taxpayer at the end of the taxation year. So remember this rule, and remember it in 5 minutes from now, and we covered, get into more depth. So you must own it at the end of the taxation year, generally, to claim CCA. And it must be used to produce income from business or property. We've talked about that. Asset must be a capital asset and not inventory. Why not inventory? Just as a matter of policy. What have you done with your inventory, or more precisely, your cost of goods sold? Have you expensed it?
Yes.
Yeah, so if I expensed it and I was able to take CCA, would I be double dipping on the same item? The short answer is yes. Would the government be happy with that? No. So that's the reason you can't claim it on. Okay, so how does the CCA system work? Okay, so each category, and I'll show it to you in a tabular format in a moment, each category of asset is assigned to a class. So building, for example, will be class 1, and with each class there will be a rate. So, you know, in class 1, there might be a rate of 4%. Cars might go into class 10 or 10.1. And the rate with class 10 or 10.1 is 30%. And as I stated before, once you claim CCA, it reduces your cost, and that is called undepreciated capital cost. And it is on that figure you can claim CCA. Show that to you in a tabular format. Just before I get there, I just want to clarify something. I can only take, and we talked about this before, CCA, I'll just highlight it, on a capital asset. So it has to be a capital asset. So if I have a building, right, and I improve the roof, I replace the roof and I improve it, is that a capital or current expense?
Capital.
Capital. If I put back the roof in the same state, or if I just repaint the side of the house,
Expense.
expense. So don't take CCA on current expenditures, only take it on capital expenditures. I've provided here, and this is similar to your accounting treatment, does, you know, the expense provide a lasting benefit? Does it maintain or improve the property? What is the value of the expense? Again, this is somewhat of a gray area, but, you know, professional judgment. If it generally provides a lasting benefit, it puts it in better shape than it was before, it's a capital expense, and that you can claim CCA. Whereas if it's a current expense, you can simply, you know, expense it.
Was repainting it considered an expense?
Repainting would generally be considered an expense. Yes. All right. So moving on. So unfortunately, and we won't, you know, I don't want to complicate matters too much, but we do have to cover it from a comprehensive point of view. So there are two methods now. So if you took this class 3 years ago and somebody asked me, you know, you would have covered this in ACRO 340. My answer is yes, you would have covered one part of the rule in ACRO 340. As the legislation is involved, there are really two sets of rules. So we'll start by the first set of rules. So these are for assets acquired before November 21st, 2018. So we're in 2021, and, you know, I have probably 55 to 60 of you may be asking, well, sir, you know, what is, you know, why are we covering assets before November 21st, 2018? And the reason is quite simple. The CCA, and this is critical, if you're going to remember one thing out of this class, like even if you have all the computations down pat, if you forget this point, all your calculations will be wrong. So, you know, this is critical. The CCA system, so if I'm taking CCA in 2021, it's based on when the asset was acquired, right? Not the year in which I'm taking CCA. So in other words, just think of it, in 2021, are there lots of assets that I can take CCA in 2021 that I may have acquired prior to 2018?
Yes.
If you're manufacturing, if you're Placerville, if you're the owner of Placerville Marie, when did you acquire that? Way before 2018. You're still taking CCA in 2021. If you acquired a server 10 years ago, you're still taking CCA in 2021. So what will determine which goes into, you know, which calculation method? The general method or the half-year roll method, which are assets acquired before November 21st, 2018. I'm just going to fast forward to the next method. Next page is an example. So on page 85, for assets acquired after November 20th, 2018, there's a whole different methodology, which is the accelerated investment incentive method, or the, you know, accelerated to method. And all of this is contingent on what? Not the year I take CCA, but the year that I want to make sure we're clear. So I'm just going to be a little repetitive here. I'm going to throw it out to the class. It's the year that I
Purchased.
purchase or acquire the asset that will be relevant. Right? So if it's acquired before November 21st, 2018, and I may be very well claiming CCA in 2021, it's going to be, you know, lots of those situations, you follow the half-year rule. And I'll cover that in a moment in terms of the methodology. And then if it's assets that I've acquired after November 20, 2018, it's the accelerated investment incentive method. Taken for granted, any new assets that I will acquire clearly will go in the accelerated investment method, but you know, the half-year-old method is still relevant. So again, it's based on when you acquired the asset, not the year you take CCA. Otherwise, you're going to get this all wrong. Otherwise, what you're going to do, you're saying I'm taking CCA in 2021 for assets that I've acquired in 2015, 16, 17. You would have, and you computed under the accelerated investment incentive method. Do we all agree you've picked the wrong method? Is that clear to everybody?
Yes.
Okay, good. All right, so the half-year rule, how does it work? And we'll go through a couple of examples. So I'll have the UCC at the beginning of the year. So if it's my first year that I've acquired the asset, my UCC at the beginning of the year will be 0. If I acquired the asset during the year, and just follow the methodology, it's very, you know, you just have to follow a method or a pattern and just follow it as I've illustrated it here, and you won't have any issues. You add acquisitions during the year, exactly as I've done here. Try to follow the same format. If you dispose of something in the year, you need to remove the lesser of your POD and ACB. So, you know, if you forgot from tax 1 what POD means, it's simply proceeds of disposition, your sales price. And ACB is your adjusted cost base, so the lesser of your POD or ACB. So when you dispose of something, you don't necessarily remove the sales price. You need to compare it to the cost, and you remove the lesser of. So then your acquisitions minus your dispositions, that excess, you will remove it, right, from your UCC at the beginning of the year, and that will give you a sub. Now I have an adjustment for what is called the half-year rule. So I'll explain the mechanical adjustment, and I'll explain the reasoning behind it. So I'll start with the reason for the mechanical adjustment, or how the mechanical adjustment works. So you will remove 1/2 net additions, and I'm just going to concentrate on the word net additions. So this adjustment of your 1/2 net additions will only occur if my acquisitions exceed my dispositions. Is positive. And when I refer to dispositions, does it refer just to sales price or the lesser of sales price and cost? Just so we're clear.
Lesser of the two.
Okay, perfect. So if my acquisitions, I'll state it in another way. If my acquisitions don't exceed my dispositions, if my acquisitions are 20 and my dispositions under this rule is 50, do I have this adjustment? Yes or no?
No.
Perfect. Sorry, it's a little bit more difficult. I'm not in a class, so I can't see, you know, the kind of your visual reaction. So I have to kind of ask these questions just to make sure you do understand. So that's entirely correct. There will be no adjustment if my acquisitions don't exceed my dispositions, only when it's positive. So I will remove that, and that will give me a base amount for CCA. The reason I have this rule is the government does not want to get caught up with petty accounting. So what I mean by petty accounting The government doesn't want you to depreciate based on the number of days, and write this down, this is critical. And we'll cover it a little bit later on as well, but I'm just going to state it now. Government does not want you to prorate based on the number of days you own the asset. So today we are January 14th. If I buy an asset today, the government doesn't want me to prorate from January 14th to December 31st. And likewise, if I buy an asset on December 20th, the government doesn't want me to prorate from the 20th to the 31st. Rather, the government will allow me to take 1/2 of the CCA I'm normally entitled to by reducing my balance. And that's the reason for it. Rather than prorating CCA based on the number of days you own the asset, okay, you can only take 1/2 of the CCA as a result of this mechanical adjustment. You'll see it in a moment as we go through the numbers. So that gives you a base amount for CCA. You'll take that base amount and you'll multiply times the rate of the class. We said each class has a rate. You'll multiply times the rate of the class. And then at the end of the year, you'll have to add back your 1/2 net additions. And that will give me my UCC at the end of the year. We'll go through a problem in a few moments, or a few problems. I just want to clarify a few things. So my UCC at the end of year 1 will become my UCC at the beginning of year
2.
Perfect. Now, some particularities. If at any moment your balance goes negative, if my balance goes negative, will be because I have a UCC at the beginning of the year, and then let's say I have $100, and my dispositions, the lesser of my POD and ACB, would be, let's say, 150. So then my balance would go negative. That means I have taken too much CCA, more CCA than I would have been entitled based on the value of the asset. Is that right from the government's perspective, that you would have claimed too much CCA? Noting if you claim CCA, that means you've claimed a greater deduction than you were entitled to. Is the government going to be happy with that?
No.
No. So what do you think the government is going to want to do?
Limit CCA you can take.
They're going to want to get it. Well, yeah, you raise a good point, limited, but it's too late to limit it because you don't know the value until you sell it. So you in essence, you've claimed too much CCA on a real-time basis. So simply, the government is going to say, well, for the excess CCA that you were entitled to, okay, I need to recoup it. And that recoup is called a recapture. So the moment your balance goes negative, it simply means you've taken too much CCA, and the government will recoup it. And the expression is called a recapture, meaning that negative amount will be included in income. So far, so good?
Yeah.
This will occur even if you have other assets in the class. So your balance will just be restated to 0. Next rule is just important as well. So if all of the assets are disposed of, and there is still a positive balance at the end of the year, could I take any CCA? So just go back to the baby basic rules that I talked about before. What did the baby basic rules state before? In order for me to claim CCA, I must own the asset at what point in time?
At the end of the fiscal year?
Yeah, at the end of the fiscal year. So if I don't own anything at the end of the fiscal year and I still have a positive balance, just think about it, should that positive balance be carried forward to next year?
No.
No, I don't. I'm not entitled to claim CCA. I don't own the asset. So if all of the assets are disposed of, and there's a remaining balance, that means you haven't taken enough CCA as relative to the value the asset is worth. So the government will allow you to recognize what a terminal loss. So it'll be denoted by a positive number when there are no assets left in the class. You'll have a terminal loss. And what do you think you can do with the terminal loss? You can deduct it from income. Yeah, so I just want to clarify a few points before we move on to going to the calculations. And the accelerated method you're going to see is very simple. Once you understand this, it's simply the reverse. So, the moment my balance goes negative, what happens?
You have to add it to your income,
Okay, what is that called, firstly?
recapture.
Recapture, and I add it to my income. What happens to the balance? It's restored to
0.
perfect. And that occurs even if there are assets in the class. Now, when I have a positive balance at the end of the year, and again, this is important, one of two things can happen. If I still have assets in the class, the balance at the end of 1 year, I will simply do what with it? So I have a positive balance at the end of the year. I still have assets in the class. What would I do with it?
Is it the beginning of next year?
Perfect. Excellent. Beginning of next year. Now, if I have a positive balance at the end of the year and I have no assets left in the class, they're all disposed of, what happens with that positive balance?
Terminal
No loss.
Terminal loss. And is there a carry forward or there's no carry forward?
I don't
Carry
think there's a
forward.
carry forward.
Sorry. So
Has to
there's
be
no.
zero.
Yeah, so I'll clarify, there's no carry forward, right? So, I mean, you have no assets left in the class, you can't claim CCA, you claim your loss. We're good with that? So I'll show you, we'll go through calculations. These are all independent scenarios from one another. So we'll go through kind of order of complexity here. Most basic situation, I have an opening UCC of 360, no additions, no dispositions, so therefore no net additions. So if you follow the grid, I have a sub balance of 360, no adjustment for the half year roll, so my base amount is 360,000 times 4%. So I have entitled to CCA of 14,400, and that gives me my ending UCC. Okay. Independent class 1, different example. No opening balance. I have an addition of 180. No dispositions. So my net additions are 180. My sub balance is 180. In this case, do my additions exceed my dispositions?
Yes.
Okay, so do I have an adjustment for the half year rule? And the answer is yes.
Yes.
Okay, so 90,000. That gives me a base amount of 90,000 times my rate of 6%, 5,400. And then what do? I simply add back my 1/2 net additions of 90,000, and it gives me an ending UCC of 174,600. Okay. Does this make sense, by the way? How much did I acquire my asset for? 180. You all agree? How much CCA did I claim in the year? 5,400. So is my ending UCC correct?
Yes.
Yes. Okay, so just the mechanics. So again, the reason for this half year rule, I'm going to state it again, and we're going to revisit it at the end of the lecture, but it's very important. You can never prorate CCA based on the number of days you own the asset. You may prorate based on something else, but you can never prorate, subject to one exception, CCA based on the number of days you own the asset. Rather, you have the half year rule. Are we okay with that? Good?
But what about when we start the business, like, let's say February, can we prorate a short fiscal year?
Yeah, when you have a short fiscal year, you can prorate CCA, but I've chosen my words, excellent question. I've chosen my words very carefully. I said you can't prorate CCA based on the number of days you own the asset. Okay? But I can prorate based on a short fiscal period, and I'll come back to that later. The distinction is very different. Does that answer your question?
Oh, yeah.
So we'll move on. Class 8, 100,000. I have additions of 20,000. I've disposed of an asset for 20,000, which costs me 10,000. How much do I remove from the pool? The lesser of being 10. Okay, so don't remove your 20,000. You always need to compare both. So far, so good? So that gives me my net addition of 10,000. So that gives me a sub balance of 110. So 100 plus 20 minus 10, 110. Or 100 plus your 10, 110. Does my half-year rule apply?
Yes.
Because my acquisitions exceed my disposition. So 1/2 of that is 5,000. So that gives me a base amount of 105. Multiply times the rate of the class. Gives me CCA for the year. And then I add back my 1/2 net additions to get back to my ending UCC. Moving on. Different scenario. Another class 8, 100,000. Having additions of 20,000. I dispose of something for 30,000, and my cost is 40,000. So how much do I remove? 30. Does the half-year rule apply?
No.
Why not?
Because the
Because
dispositions
it's
are higher than the
less than.
So both of you got it. My additions don't exceed my dispositions, or my dispositions are greater than my additions. So half-year rule doesn't apply. I have a sub balance of 90,000. Multiply times the rate gives me a CCA of 18,000. All right, moving on. 110. Opening UCC, no additions. I have dispositions. I sold something for 100. My cost is 85. So how much do I remove from the pool? I remove 85 from the pool. So far, so good. If I tell you there are no, this is the last asset that they disposed of. What happens?
Terminal loss or recapture.
Your first answer was correct. I have a positive balance of 25,000, and I have no assets left in the class. So what does that mean? It's a terminal loss. I haven't claimed enough CCA. And what do I do with the terminal loss? Even though it is denoted by a positive number, I would
Subtract.
subtract it.
Deduct from income.
Excellent. Very good. Okay, moving on. Opening UCC 6,000. No additions. Dispositions. The least of 17 and 20. So how much do I remove from my class? 17. And oops, my balance goes negative. When my balance goes negative, what happens? Taking too much CCA. So the government's going to say, I want to recoup it. So what do I do with the recapture? Even though it is denoted by a negative number, I add it to income. So far, so good? We'll move on to the accelerated investment incentive method. So, as we go, as you move forward, all new assets that you've acquired will obviously fall under the accelerated investment incentive. But as I explained before, you can't simply ignore the half-year rule method because those are still in existence. Because, a lot of businesses have acquired their assets prior to November 20th, 2018. So the model is very similar with one adjustment or a few adjustments. So the UCC at the beginning of the year stays the same. I, again, add my acquisition of eligible assets during the year. And I'll come back to what eligible assets are. Actually, I've defined them here at the bottom. They're acquired after November 20th, 2018. They're available for use. They were not eligible if it was previously owned by a non-arm's length person to you. So just to clarify, non-arm's length person to you means somebody that was related to you or on a rollover basis. So we'll cover rollovers after the midterm. There's no requirement that the asset be new. So I just want to clarify because the way this is written may lead to confusion. So you might say, well, if there's no requirement the asset has to be new, what does it mean by previously owned? So in other words, previously owned is meaning if I owned it prior to November 20th, 2018, it's simply not eligible for the accelerated method. Okay, so it's assets that I already had on hand. But if I buy, let's say, a building from one of you, or I buy a manufacturing equipment from one of you that is used, that is fine. I bought it today in 2021. That would meet the criteria. That would not be interpreted as previously owned. It means previously owned by me. Is that clear?
Just to just be sure, if you were to buy it, like you were saying before, if you were to buy it from one of us, the building,
yeah,
and would it matter whether or not, let's say, I acquired that building prior to the November 2028?
No,
it wouldn't matter, right?
Absolutely not.
Okay.
Okay, so just wanted to clarify between previously owned and no requirement that the asset be new. That sometimes causes confusion. Are we all good with that?
Yep, makes sense.
Okay. So it has to be an eligible asset. So they just want to make sure that you acquire, assets after November 20th, and you're not, if you had assets before, that you're not carrying them over after. That's kind of the gist of it. The dispositions is, again, the lesser of the POD and the ACB, and then you get to this sub-balance. Now, the difference is, on the half-year rule, what would I do with the 1/2 net additions? Anybody remember?
You would deduct.
Under the half-year rule, I would deduct. So now what is happening, sorry if I went a little bit too quickly, I would simply add. It's the inverse. So in other words, what they're, if you kind of understand the model, you're able to claim more CCA in the earlier years. That gives you a base amount for CCA, gives you the deduction based on the rate of the class. And then instead of adding the CCA, you would simply, or the 1/2 net additions, you would simply subtract it. So it's really the exact same model before, except where this was less, now it's the opposite. It's add. And where this was add, now it is less. So it's the same model, but the half-year rule is just the opposite or inverted. Are we all okay with that? Yes, no?
Yeah, makes sense.
Yeah.
Recapture asset. So look, I have the exact same numbers as before. I won't go through all of them. I'm just going to pick 2 of them, and I'll just show you. So as I said, the whole gist of this is the government wanted you to take, they wanted to stimulate the economy. They wanted you to take more CCA in the earlier, years. So the first one really won't change because I have no acquisitions. I have my opening UCC. So the first one will be the exact same situation under the half-year or the accelerated. The next 2 will be a little bit different because I have an acquisition during the year or after November 20th, 2018. So I have an acquisition, no opening UCC, an acquisition, no disposition, no addition. 180. So I have my 1/2 net addition adjustment. Rather than subtracting it under the accelerated method, what do? I now add. So that gives me a base amount of 270 times my CCA rate of 6%. So that gives me CCA of 16,200. Under the half-year rule, just to show you, this kind of confirms what I said. Under the CCA, the half-year rule, the CCA was 5,400. Are we considerably more now? 16,200. Almost 3 times as much. So does everybody see that they wanted to kind of stimulate the economy with this method?
Yeah.
Let's see, just now I would simply subtract the 1/2 net addition. So same model, but inverted. And obviously my ending UCC will be much lower than was before, 180 minus the 16,200. Go through one more example. So opening UCC of 100,000, additions 20,000. My dispositions, so from the previous page, will be 30,000 that I've used before. So I will have a sub balance of 90,000. In this case, would you expect to see a difference?
No.
Why not?
Because the additions are less than dispositions, and that's where the, what do you call it? The net additions would be in effect. The ACLL rules would be in effect. And in this case, the negatives we don't take into consideration.
Okay, so and then I'll show you this one, just to compare and contrast. Excellent answer. So 100,000, now my addition's 20, my disposition's 10. So I have net additions of 10, so that gives me a sub balance of 10. Now I add my 1/2 net additions, so it brings me to 115. So I have a greater amount than before to claim my CCA on, my base amount. So I have CCA of 23,000, which is a little bit more than in the previous example, which was, 21,000 because of the accelerated. Are we okay with all of this?
Yes.
All right. So in a moment, we're going to get kind of in the nitty-gritty rules. So what I will say is you can only start taking CCA once it's available for use. So depending on the type of property, you have it here in the notes. If it's a property other than the building, it's when you first use it to earn income, or it's after the second taxation year after the year you acquire to use the property. And if you have a building, you can generally only start taking CCA on the building when 90% or more of the building is used in your business. So this is really to capture situations where the building is being constructed or renovated. You'll see 2 and 3 kind of overlap. On page 88 and page 89, I've given you an overview of the rates, the most common rates, which I will go through in the in the subsequent material. Now, so this is kind of your summary sheet, for lack of a better expression. Okay, so now is what I don't want to call the difficult part, but it's obviously the more tedious part. So this involves determining which asset goes into which class. And we're not going to cover all of the classes, and it's a good thing. We're going to only cover the the main classes that you'll see, and I generally follow it in line with the textbook. So that being said, obviously there, I'll present it this way. There are these strange dates, and I'll talk about why there are these strange dates. It's simply there was a budget that date, and so the rule was in effect as of that date. So why you need to know which asset goes into which class. We said each class is associated with each class has what? A rate. So you need to know which asset goes into which class because each class has a different rate. And even within the same class, you can have different rates. And again, I'm just going to reiterate, and it breaks my heart, and that's why I'm going to say it again. And I don't want this to happen to anybody. What did I say the key term was? And it's going to be the same to determine when you determine which asset goes into which class. The year I'm taking the depreciation, or the year that I've acquired the asset?
The year that you acquired the asset.
Okay, the year that I've acquired the asset. So, I can't stress that enough. If if you're going to concentrate, unfortunately, on the year in which you claim CCA, you're going to get the methodology wrong and you're going to put it in the wrong class. So even if you know all of the other rules perfectly, you're just going to get, unfortunately, a 0. You're going to miss both. So I can only stress it enough. The key, term is acquire. And you acquire will also determine in which class the asset goes into. All right. So I have a class 1, a building acquired after 1987. The rate will be 4%. And again, some of you might be thinking, well, Joseph, we're in 2021. Is this really relevant? And yes. So the example that I talked about before, are there many buildings that are owned now by their present owners that were acquired after 1987? Are most of Montreal buildings, or a lot of Montreal buildings, are they older or are they newer?
Older.
Older. So this rule is still very relevant. The rate would be 4%. In 2021, when I'm claiming CCA. Just so we're crystal clear. Now, as we've progressed through time, the government wanted to give preferential treatment to certain types of buildings. So, a lot of you might be a little bit young, but around 2007 and 2008, the economy wasn't doing so well. There was a recession. The government wanted to stimulate the economy. So they said, if you acquire, and notice all of it is contingent on acquire, a building after March 19, 2007 will give you your base rate plus a bonus rate of 6%. So you'll have a full rate of 10% on manufacturing and processing. And if it's a non-residential building, you'll get your base rate of 4%, but a bonus rate of 2% for a total rate of 6% on non-residential buildings. Okay, so I'll just give you an example. If I buy an office tower, okay, in 2008, and I lease out the space commercially, what rate would I go into class 1, but at what rate?
6%.
6%. Very good. In order to access these rates, you need to elect to put them in a separate class. So in other words, it's going to be class 1 4%, class 1 10%, class 1 6%. Okay. I'll present a rule, whether it's for class 1 or for any election as we move forward in the notes. You always want to elect. I'll tell you why. So other than, accessing the higher rates, the other reason you would want to elect is you'll recognize generally the recognition of a terminal loss. Let me explain. If I buy 4 buildings in 2008 that are used for manufacturing and processing, and I don't elect, they will all go into class 1 at what rate?
4%.
Excellent. And I can only claim a terminal loss when I have. When can I claim a terminal loss? When I've disposed of what?
All the assets.
All assets.
All of the assets in the class. So I would have to dispose of my 4th building to claim a terminal loss. However, if I elect to put them in a separate class, so I've acquired them all after March 19, 2007, I acquired them all in 2008. Now, every time I dispose of a building, that's the last asset in that class. So I can essentially recognize a terminal loss. Okay, so it speeds up the recognition of the terminal loss. That's the other benefit of an election. Is everybody clear with that?
I just have a question. I know you can have 3 class 1s for the different percentages, but can you have, like, let's say you buy 2 manufacturing buildings after March, can you have them in different, like, although they're the same class, same percent, can you add them in a different category, or they have to be grouped together?
No, you can put them in a separate category.
Each.
Yes, each.
Okay, perfect. Thank you.
So just to make sure I get it right, so if we're looking at class 1, if we're looking at a different rate, would that be considered a separate classification, or?
So I'll answer it this way. Yes, but don't look at it in terms of the rate. Again, look on it when it was acquired, right?
Okay.
So if it was acquired after that date, you can elect to put it in a separate class. And
Okay.
The benefit of that is you access the favorable rate, but you also recognize or speed up the recognition of the terminal loss.
Okay, that makes sense. All right, thank you, sir.
So I'm going to move, I'm not going to, again, so I've stressed the word acquired. I'm not going to stress it as we move through because it's just going to become redundant. So, all of this is when the asset was acquired. So, that's the big takeaway from this lecture. So, Class 3, buildings acquired prior to 1988. The only thing I will say is at 5%. You can forget about the notes before if you have an improvement or not. And that still may be relevant. Again, Place Ville Marie probably was acquired in, sometimes in the 1970s. It's still owned by its probably current owner. And again, when it was acquired, I was going to stress this, if it's before November 21st, 2018, it's the half-year roll, and then otherwise it's the accelerated method. Really both.
A question.
Yeah.
Let's say for the asset, if we acquire asset from before November 2018, after November 2018, we put in the same class.
Sorry, if you acquired an asset,
If a taxpayer acquired asset from before November 2018 and some after November 2018, do we put them in the same class or we separate class?
so I'll answer it this way. It can either be one or the other. So the taxpayer either acquires the asset prior to 2018, and if he acquires it prior to 2018, okay, it's the accelerated method. Then you're going to have to ask yourself for the building, okay, what year was it acquired? So if you tell me it was acquired in 2018, if it's a manufacturing, it's going to be at 10%. If it's a non-residential building, 6%. Otherwise, it's going to be at 4%. Does that answer your question?
No, I think I'll ask later.
So again, you need to ask yourself if it was acquired, which method, and then you need to follow, the acquisition dates to determine what rate it will be.
I think he's asking if, let's say, you already have a class 1 at 10% prior to 2007, and then you bought something in 2000, let's say 19, would you have to class them differently because of the different methods?
Okay.
Or can you group them all in one? I think that's his question.
Oh, yeah.
If
Okay.
Class 1 for other class, say class 8, class 10, class 12,
So
so on.
whatever you've acquired after, so if I acquired a building in 2008 and it was at 10%, okay, it will stay in that class at 10% for life. Now, if I acquire a second building, so what date do you want to acquire your second building? Tell me a date.
November 2019.
November 2019, okay? So that will be the accelerated method. If it's a building used for manufacturing, because it was acquired after March 19, 2007, it will be 10%. If it's a commercial space, it will be at 6%. If it's neither of those, then it will go at 4%. For your 2019. The 2008 building will stay at 10%.
Well, I mean, if there's no election, so we put in the same class, huh?
If there's no election, it goes into class 1 at 4% by default.
Oh, the same one, okay.
No election, you're stuck class 1 at 4% at the cheap rate. That's the way the government views it. Does that answer your question?
I have a question. So if you buy multiple buildings, but they have, some are manufacturing, some are not. They're in different classes. So if you sell all manufacturing, for example, you could get a recapture or terminal loss because they're in a
Yeah.
different class.
Yes.
Okay,
that's-
thank you.
yeah, absolutely. So moving on, class 8. So I'm not going to restate if it was acquired before or after, as I said, for all of them. Class 8 deals with machinery, equipment, and furniture. They will all go into class 8 at 20%. If I have a photocopier, fax machine, or telephone equipment, and they have 1,000 for a cost of $1,000 or more, you can elect to put them in a separate class 8. Why would you elect to put them in a separate class 8? Anytime there's an election, you said you probably should. Why?
To trigger a terminal loss earlier.
Right. Perfect. Class 10. Okay. We're really going to go through class 10 and 10.1. So these are a little bit tricky. Not too tricky, but you just have to pay a little bit more attention. So class 10 is at 30%. It applies to motor and passenger vehicles other than those that are subject or categorized in class 10.1. We'll take a look at 10.1 in a moment. So motor and passenger vehicles are the biggest one, automotive equipment, trailers, and wagons. So rate at 30%. If it's acquired after March 19th, 2009, and it's a zero-emission vehicle. So could you give me an example of a zero-emission vehicle?
Tesla?
Tesla. Their government wants to promote, all this green activity. It will go into class 54 and you will have 100% write-off. So we'll get to that after. Okay. So class 10 deals with motor and passenger vehicles other than class 10.1. So I have to know what 10.1 is. So 10.1 deals with not motor vehicles, but what type of vehicles? Passenger vehicles with a cost of more than $30,000. So your next question is, well, sir, what is a motor and what is a passenger vehicle? And I apologize ahead of time. I don't make the rules. I teach them. You'll have here a grid of what is considered motor or passenger. So generally speaking, I'll talk about, common. A passenger vehicle would be a luxury car. So if I have a luxury car that costs $28,000, does that go into class 10 or 10.1?
10.
And if I have a luxury automobile that costs more than $30,000, does that go into class 10 or 10.1? Costs, let's say, $45,000, my BMW.
10.1.
10.1. Now, just so we're clear, if I have a pickup truck, what is a pickup truck? Is that passenger or motor?
Motor.
Motor. So if I have my Ford pickup truck that I acquire for $60,000, because I'm in construction, and I put all my wood, does that go into class 10 or 10.1?
10.
10. And there's no cap to it. So 10.1 only deals with passenger vehicles. So good. So, passenger vehicles, which cost is in excess of $30,000. Yes.
I actually have a question because there's that new thing that you said of March 19, 2009 with zero emission. So even though it's above 30,000, it would still be 100% write-off?
For the zero emission, because that is specific, that overrides the rule. So if I have a specific rule like that, yes, it will override the rule.
Okay, because I think there are no electric cars less than 30,000, so it would automatically be written off 100%.
For most cases, generally written off at 100% because they're capped off on the first 55,000, but we'll examine that. So like you
Okay.
have a Tesla that can cost you 70 or 100,000, right?
Okay, yeah, that's fine. Okay, perfect.
If it's lesser, you're absolutely. So class 10.1, okay, very important. So each vehicle, each class 10.1 vehicle must be allocated to a separate class 10.1. The maximum you can add to the class is $30,000 plus GST and PST. So if I buy a BMW for 45,000, right, I can only add 30,000 to the class. In the year the old class is disposed of, and I'll go through an example. You can't calculate a recapture or terminal loss. There's no recapture or terminal loss on class 10.1. So instead of claiming your terminal loss, they will allow you to claim 1/2 of the CCA you're normally entitled to. So the rate is 30%, 1/2 is 15%. And the way you do that is you'll take 15% of your opening UCC and claim that as CCA, even if you don't own the asset at the end of the year. And that's the trade-off for not having a terminal loss. So I'll go through an example with you, and I'll go through the half-year rule and the accelerated method, and you can just concentrate on this example because students make silly mistakes and there's no reason to. So if I have an old BMW that I acquired in, 2012 that is now worth 14,000, let's say today, and I dispose of it. And just be careful, the lecturer might not say you disposed of it, she just say you traded in your car. So if I traded in my car, I disposed of my old BMW for my new BMW. Okay. And I acquire a new BMW for 45,000. No need to put any additions or dispositions in the column. Your textbook might, but it won't do anything with the numbers. Rather, in the year that I dispose of my vehicle, what am I allowed to do? I'm allowed to claim 1/2 of my opening UCC, or 1/2 of 30% of my opening UCC, so 15% of my opening UCC of 2,100. So don't calculate a recapture or terminal loss. In the year you dispose of your old vehicle, take 15% of your opening UCC. So far, so good? For your new vehicle, if you acquired it before November 21st, 2018, if I acquired my BMW for 45, will I add 45 or will I add 30?
30, because it's capped at 30.
Capped. All right, so that result, if you follow the half-year rule, will always give you 4,500. If it's after that date because of the accelerated method, rather than less, you're simply adding the accelerated method, that will give you a CCA of 13,500, almost 3 times as much. Okay, so what students do wrong is the following. They'll say, okay, well, I disposed of my old BMW for 20,000. I'll put something in my disposition column. They'll say I acquired my new car for 45,000. So there's a few mistakes there. Firstly, there's no recapture or terminal loss, so you shouldn't put anything in additions or dispositions. The other thing is each new addition goes into a separate class, so you need to put it into a separate class. And then furthermore, you shouldn't be putting 45,000, you should be capping it off to the prescribed amount for 30,000. So that's kind of best practices as we move forward. I'm going to do to class 12, then we'll take a break. I might run over, sorry, just a little bit over this class just to make sure that we do cover the material, just because of the introduction and I'm just waiting for everybody to watch it, right? So don't want to do that on very often. Class 12. Class 12 deals with computer software, not system software, and small assets. The small assets would include dental, medical instruments, kitchen utensils, and tools if they're less than 500. So what do we mean by computer software and not system software? What would be computer software and what would be system software? Would Microsoft Office be computer software or system software?
Computer software?
Okay. Would Windows be computer software or system software?
System software.
The accelerated method is, so the rate is at 100%, generally speaking. So if it's a rate at 100%, subject to some exceptions, the accelerated method is really not applicable because I'm just writing it off all in 1 year. The following assets, the half-year rule will apply to assets other than the following Class 12 assets. Okay, so in other words, these items that are on this list, you cannot write off in 1 year. They're subject to the half-year rule as long as they were acquired prior to November 20th, 2018. A book, Chinaware, kitchen utensils costing less than $500, medical or dental instruments, linen, tools costing less than $500, uniform, rental apparel. For all intents and purposes, if we're in 2021 and you acquire this prior to 2018, and because of the half-year rule applies, you apply it, you write it off in 2 years, 50% in 1 year and 50% in the second year. Would you expect to see anything, for the most part, in 2021? What would your answer be?
Yes, the half of the 2018 for 2021.
Generally, you would not expect if the taxpayer has written them both off in those years, right? Because they would have written 50% off in, prior to 2018 and the remaining after that. So in 2021, you probably would not see any as long as they claim the maximum amount. Does that make sense to everybody? So for the, sorry, I didn't get your name for the person who was just commenting. Does that clarify it for you?
Yes, sorry, yes.
All right, so it's 7:10. Leasehold improvements is a complete deviation of the methods that we've seen so far. So I kind of need you well concentrated. Is a 10-minute break good, sufficient for everybody? Or do you guys want a little bit more?
I'd like to ask questions.
Sorry?
Can I ask questions?
Yeah, go ahead. So we'll come back. Yeah, so we'll come back for everybody. Let's say it's 7:11 now. We'll come back around, like, say, in 10 minutes, around 7:22:23. Yeah, go ahead.
Yeah, why is painting not considered a capital asset?
Generally, painting is not considered a capital asset. I'll go back and show you, because you've put it back in the same form that it was. So you haven't extended the useful life. So if my paint has ripped off and I just repainted it, I just put it back in the same position that it was. The only thing that I would say to that is, unless you had like some cheap, I'm no expert in paints here, right? But if you had some cheap acrylic paint that lasted for 5 years and now you have some, excellent oil-based paint that lasts for 20 years, in that circumstance, it might be a capital expenditure because it provides a lasting benefit.
Would that be the same for all maintenance expenses?
Generally, yes.
Okay, now that makes sense.
Does that clarify?
Yep.
Okay, perfect. So what I will do, everybody, is I will just stop the video and I'll resume around. I'll put it on mute. I'm going to let the recording go on. And we'll start back at 7:22 if there are no other questions. Is that good?
Yeah.
Excuse me, Professor. Yes. May I ask a question? I'm still confused about the separate class thing. Is it we only have one separate class, or for every item we have 1, 2, 3?
It depends. So look, we've gone through it.
Mhm.
show you class 1. I have base 1, it goes into 4%, and I can elect to put it in a separate class if I acquire it after March 19, 2007, and it's used for manufacturing and processing. If it's used for non-residential, I can elect to put it in a separate class. So I would have, in this instance, 3 class 1s. Can you see that?
So I can have multiple like items in the 10% separate class.
Yes.
Okay, and for the luxury vehicle, it's like one vehicle, one separate class, or
Yes, absolutely. Each vehicle must be allocated, here if you see it, to a separate class 10.1.
okay, so they work like differently.
Yeah, you really have to you have to understand and read the rules and understand each one, right?
Yeah, okay, thank you.
All right, so I'll just put the video on, I'll let the recording keep on running and we'll resume around 7:22.